Hey everyone, I'm Sebastian Purcell from The Art of the Bubble, and for this week I decided, given the fact that the market conditions are kind of changing in the crypto world, it might make some sense to go through and put together an explainer of the three-stage algorithm that we use to figure out where the heck things are going, or at least, actually it's not so much that, how to respond to the market conditions given how they are right now. Nobody has a crystal ball, right? So this is the strategy that I've used for a long time, and the basic component of it has had about a 5-year walk forward. It's a basic economic cycle, so it's grounded in macroeconomic analysis, and then it gives us a sense of how to respond to what we're seeing. And I have explained this over, I don't know, 7 or 8 different specific lessons, and they're all on the artofthebubble.com website, right? A lot of it is explained in lesson 9 of the Art of the Bubble guide, and also deep dive number 5. That's somewhere quite a bit of this is. But yeah, you'll have to go through it like a number of different pieces there, and so it might make sense just to put it all together in one place so that it's self-contained. That's what this is, and this way you'll know kind of like what each one of the signals means when they're coming out, and even if you don't pay for like the crypto writer, the bubble writer tiers, you'll kind of know where we're going with this analysis, and so you can structure your own approach, because that's kind of the idea. If you're like a DIYer, or even if you're a free subscriber, you want to know how to structure your own investment approach, and this can help with that. Okay. So, question that I was getting all this last week was like, which coins do I buy now that things are getting better, and what do I do with this thing that you keep on posting in the Seb Cryptos channel? This is for the crypto writers and bubble writers, and they get a little thing that looks like this. And wait, what does it mean exactly? Okay, this is clearly a partial watch list of what we're looking at. I think an image will organize most of it. I call this the three-stage algorithm because it proceeds in 3 different stages. There's a bottom portion of the pyramid, a middle, and a top portion. And you have to go in that order because if the basic economic cycle goes, everything else is like not even worth paying attention to. If the basic economic cycle is good enough, but the industry is crap, don't ask for specific coins. And finally, if those 2 are good, then you can go on and look at specific coins and make some decisions at that level. So that thing goes at that top level. That's really just which coins. I sometimes post these things in the channel, charts that look like this. That is over the total, like the total crypto market cap, and that's the industry level analysis, right? Technically, I use this for stocks too, at all kinds of different industries, for different lead indicators for each one of those that I'm trying to trade that would be bubbly. And then I used to post these things, and I stopped posting them because it confused people. They would always be like, what is a yellow 3? What is with all of these colors? I don't know, I'm getting confused. Just give me yes, no, buy this coin. Okay, you'll see why I've always resisted that approach, because yes, no, buy this coin doesn't quite work on its own. I don't have a 1-stage algorithm, I have a 3-stage algorithm. So if you're looking at that top level only without looking at the prior 2 levels, you might end up buying coins in totally the wrong conditions, okay? So everything starts with the basic economic cycle indicator, the BEC. And the reason for that is because when the macroeconomy crashes, everything goes down. Here's an image in March 2022 crash. There's Bitcoin and the SPY. The SPY is a little blue dotted line. That's the S&P 500. It's an ETF of the S&P 500. It doesn't trade 7 days a week. That's why it's dotted, right, for the weekends. Anyway, you'll notice they went down at the same time. Didn't matter. No, Bitcoin is not like right now, definitely not functioning as a safe haven. Not doing that. Crashes at the same time. That's the problem. When the basic conditions for the economy goes, everything goes. And just to show you, this is what a liquidity crunch looks like. Okay, what you have in the black there is the SPY, in the blue is gold, and the green there is the TLT, that is 20-year treasuries. Technically, those shouldn't all go down together, but they did. They went all down together right in the middle there, and that's a liquidity crunch. What happened was that even though, you're incentivized to go to risk-off assets like gold and bonds when, the stock market's declining, it doesn't matter when large institutions have to just sell because they don't have enough cash to cover declines. They sell everything indiscriminately. That's a liquidity crunch. There's not enough money in circulation. They sell it all, and it all crashes at the same time. Yeah. So paying attention to the back matters. Like, how do you avoid that? You got to know about the macroeconomy's health. There's no other way around it. You have to know something about the macroeconomy's health in order to avoid that. Oh, and if you're worried, like, oh, those are slow indicators. If you build a good macroeconomic indicator, you can respond quickly, even to things that you wouldn't think are macroeconomic. I was out of all of my leveraged trades, for example, before the big March crash happened. So mid-February, I traded out of them. That's what the Beck told me to do, so I was out of it, and I watched everything peacefully crash down. I was like, oh, I was at a conference in Chicago. I remember it very clearly. I was like, oh, well, that's kind of surprising. Anyway, I was safe, right? So the macroeconomic indicator can give you some lead time. That was a few weeks, about 4. It's not always, and that's for like in the stock market, right? So it's not always that much for cryptos, but it can give you some lead time, and it's worth paying attention to. How does it work? Well, here's the basic insight behind it. This is Fred data, right? This is a source of the U.S. Bureau of Labor Statistics. And the main blue line that you see in the middle there is the unemployment rate. And the gray stuff that you see there, those are recessions. And you'll see like on the very end there, bring my pointer out, very end here, this is COVID. Boom. Okay, so that one didn't really give me a lot of forewarning, but if you kind of go into the rest of these, the unemployment rate starts ticking up if you really zoomed in there. I mean, this is a lot of years, right? If you really zoomed in, you'd see that, roughly speaking, the unemployment rate ticks up 9 months before an actual recession. So that's a pretty useful indicator, right? And so you could take that idea and say, like, okay, I'm going to measure just the unemployment rate and make sure that it doesn't tick up too much by some well-defined measure. It doesn't tick up too much too fast, and then trade based on that. And if you did that, you would get something like this. I was like, oh, well, that's pretty good. That's, I mean, the blue line down there is the stock market. The red line is the same thing, just trading in and out of the stock market according to the unemployment rate. But if you go forward into COVID, you'll see that, because obviously unemployment didn't take up a lot before COVID. It just kind of slammed into it, right? And you got that thing. So, all right, you need more than one indicator. That's what that means. Why did you think that one indicator would be enough for an algorithm, right? That would be robust. So you need a multi-signal indicator. And that's kind of what I did here. This is an updated version of that chart. There's a little bit here. You'll see a little jag here. That's in fact an artifact of the way I had to just back test the algorithm. I showed this in one of the articles because it switches into bonds, and I wouldn't have been switching into bonds at that point. I'm just testing the signal worked, right? The signal was right. It's just that even bonds hit a liquidity crunch there. So, it's always a question of where you stash your money. If it's not going to be in cash, like right now where we have like a large inflationary environment, you wouldn't want to put it in cash. Maybe gold or something like that would be better. You wouldn't want to put it in bonds because you're just going to lose money for bonds unless you have like a 2-week time frame, right? So here we go. You'll see this worked out pretty well. And if, for the quant geeks out there, here's some simple stuff. It's got a Sharpe ratio over 1 and a Sortino ratio over 1.5, about 1.6, and that's in the trailing 3 years. It's done a little better historically since 1999. So it's a fairly robust indicator on its own. Okay, that had a lot of additional signals. But that's not everything that I included in there, because this is honestly not fast enough. We had more stuff. I added a rapid responding signal. That's how I actually got out of COVID early. It's futures market data. It's not integrated into that. It's integrated in a different set of software, which I'm not going to show here because that's some real magic like special sauce stuff. But that's what I did on that end of things. And then I put the two of those kind of indicators together and we integrate them into a 5-point scale. And that's where all the colors come from. A green 5 means, hey, the macroeconomy is good enough that you might want to pick up leverage stocks. I'm not saying you should if you see a green 5, but that's where with the, there is a leveraged bubble. There's a leveraged portfolio in 2021. It returned 84% in stocks, right? Just stocks. And that's what it follows is, hey, macroeconomy is a green 5, go into leverage, right? A green 4 means get out of leverage, and you can stay in the, whatever indices. It's good, but it's not that good that you'll want to leverage things. A yellow 3 means it's not great. You're probably going to get a lot of sideways action, a lot of volatility. The market, since the beginning of the year, has been more or less at this range. It actually dipped into red 2 for a little bit, but it's been more or less at this range for the whole year. And that just says it's okay to examine specific industries, right? Red 2 means, nope, I don't care how good specific industry momentum is, like, unless you had like some kind of counter-cyclical thing. Sorry, caveats aside. Nope. Don't even look at the industries. The macroeconomy is too bad. Everything is going to come crashing down. And a red 1 is, yeah, it's so bad that finally you might want to think about shorting things, okay? So you'll notice that leverage on the one hand, green 5, and shorting on the other hand, a red 1. Those, there's 2 levels of green and 2 levels of red. That's why I distinguish them, because not being in the market is different from conditions that you need to short the market. Those are different things. And so that, like, just as being in the market is different from being leveraged in the market. It's why I kind of separated them out on a 5-point scale so that we could get a good sense of that. Okay, and that is the first level, that's the first stage of the 3-stage algorithm. All right, so the takeaway here is that if the BEC is at least a yellow 3, then check for the industry level. What the BEC does is it tells you whether to invest realistically. Okay. At an industry level, that's where you get something that looks like this, right? A bunch of lines, and you see me drop it. I'm like, what the heck am I doing here? Okay, at an industry level, what I do is I have a set of momentum-based signals, right, which combine to give independent signals of when to scale in and out of trades. And I discussed the idea of scaling in and out in lesson 12 of the Art of the Bubble, right? So it'll tell you something like, should you be 20% in the crypto market, 40% in the crypto market? And if so, like say you're 40% in the crypto market, then the rest would be yield farming or gold or for stocks, right? Something like that. That's what it tells you, and it's over a lead indicator. I can tell you what this one is for the crypto market. It's the total. It's just all cryptos, right? Which incidentally, just as a note, remember, we are at, and this is a fairly recent image here, so almost 2 trillion. Apple's about $3 trillion. So all of the cryptos are worth 2/3 of Apple stock, just one company. So if you were worried that maybe you're too late to get into the crypto market, no. Like all cryptos, all of them, just all of them together is 2/3 of Apple stock. So we are really, really early in this game, right? Anyway, what this industry analysis does is it tells you how much to invest in an industry. 20%, 40%, 60%, you see, it tells you how much. And then you go to stage 3. And a little bit of the Aurelius Dow here. This is going to change in conception, but we found, I think, a workable path forward for you all. I didn't want to issue securities. Sorry, my livelihood turns on working in that space, so I can't touch securities fraud. So we had to restructure it a little bit. I think we have something going forward. And this is the idea for crypto maximalism comes right from this third level. What the third level does is it checks two things. Is the coin trending up relative to US dollars? And is the coin beating the benchmark, which in this case is Bitcoin, right? Is it doing better than Bitcoin, right? The crypto maxi just uses that third level. It actually just uses that last bit. Is this coin beating the benchmark? Yes, no. If not, then hold Bitcoin, because remember, a crypto maxi wants to maximize their total amount of cryptos. So they're always holding cryptos. They're just, holding Bitcoin or an alternative, right? So this third level then can give you a pretty quick way to get the signal for the Aurelius DAO that we were going to, as we originally conceived it. Like I said, it'll be a little different now. It'll be a suite of options for you all, but that's how it worked. Okay. So some caveats follow. There are often quite a few coins to invest when the market is good. That is, coins that are both trending up relative to US dollars and beating the benchmark. So if there are too many of those such coins and everything else is good, right, with the three-stage algorithm, which coins do you pick? And my answer here is, well, realistically, any should be good. I select my own personal favorites. That kind of comes down to a VC-styled analysis, which is the crypto world's version of, value investing. And I have another lesson on that, on the Art of the Bubble, on how to structure a moonshot portfolio. In that lesson, I also explained the VC checklist, kind of like what you're looking for with those projects, right? And that process is how I selected Luna to begin with. It's also how I select, like you saw that watch list, like which coins go into the watch list. Well, it's the same sort of VC style analysis, right? So which coins go into the watch list, and then when there are too many good coins, which ones I actually select. That's where a little bit of something like value investing does enter in at the third stage. So as a summary, stage 1, the BEC tells you whether to invest, like is it a yellow 3 or better. Stage 2, the industry analysis tells you how much to invest. Excuse me, that was stage 2, tells you how much to invest, and stage 3 tells you the individual analysis, which coins to invest in, and if there are too many coins, you can either just pick up your own mix. And honestly, because there's quite a few followers, if we're all doing exactly the same coins, that might become crowded trades. So maybe you want to pick some of your own random favorites that just kind of fit the analysis that are in the broader grid. That's fine. And if you guys want to suggest more coins to track, Sam and Dom are helping me track all of these coins on a daily basis, and so that's Dom Vieira and Samantha Russell. So they have access to this stuff. They'll be able to add more coins into that list. So we can have the ones that I'm looking and some community coins. I think crowdsourcing which ones to look at is probably a smart idea. So we can do this collectively, bring it all together there. But that's where the VC analysis comes in if you have too many of them. But if all the other conditions are good, it's a rising tide. You're probably going to make money anyway. So the AOTB, or the Art of the Bubble dynamic portfolio, just a note on that, remember that the dynamic portfolio for cryptos is both the result of this three-stage algorithm and the result of the yield farming strategy. That's why when you're a crypto writer, you get both yield farming and the crypto report, is so that you can combine the information from both of those. Like if it's saying you should have 40% cryptos, the rest of it needs to be in yield farming. And maybe you want to know what to look at in yield farming, right? So there we go. The dynamic portfolio combines both of those, and that's how it gets its returns. All right, that's everything for you right now. That's how the three-stage algorithm works. That's how I've consistently beat the market. And all the years I've been doing this, that's how I get the really fantastic returns like I got in 2020 and 2021. That's how I knock out volatility, because part of this is always a lot of it is yield farming. A lot of the time, I knock out the volatility in the market as it's going up and down, right? And that's the source of all of the colors and things like that, what the little individual graphs mean where I am in the analysis. So I'm probably going to pin this to the page somewhere. I hope it makes sense. I could go like in way more detail about it, but this is already long enough. So there we go, everyone. That's the video for this week. I'll see you in the next one of these. Take care.